Have you ever been told when you were on active duty that something might happen to your family if something happens to you, and therefore therefore your family would have trouble financially, and that's typically the way that life insurance gets sold to military, based on, well, really to anybody. It's based on the fear of what might happen, and that's all true, but as you learn more about how marketing, advertising, sales, persuasion, communication in the business world works, you can kind of peel back the layers of what's really happening. So when I got out of I didn't really run into this when I was active duty myself, but when I got out and got into the financial space, it of course became the big issue. Why? Because it's the widget that we're selling to make an income, right? So you got to find the best way to do it. There's 1,000 other people doing the same thing. So what makes it different, and or how do you make yourself different? Because at the end of the day, you can go to any life insurance company or your life insurance agent and get more or less the same type of stuff. It just depends on what each individual company or insurance policy or agent offers or has access to, how it complements military or government programs that are already in effect or available as well. So it can get very confusing. And there's a couple different versions of the way that life insurance gets marketed that doesn't get talked about too much. But I want to bring Gary in real quick, just to, from your perspective, Gary, tell us a little bit about how you started to learn about life insurance, just from zero to wherever you're at now, in a general sense, and how your perspectives might have changed, being on active duty as deployments came up or not. Of course, when you had a family and young kids, all those kind of things. Just what's generally, at least from your experience, happens on active duty when these type of, you know, weird and kind of gross. That's why I made the photo of, I don't know if you saw the photo of the thumbnail for this thing, but I
Yeah.
was like, ugh, like who wants to talk about this stuff? And there's a reason people get upset and they're like, oh, I had somebody do this. And I feel bad because in the past, I don't think I was very good at being too sleazy because I didn't like doing the golfing and
Yeah.
schmoozing and that kind of stuff. But at the end of the day, you're doing some version of that if you don't truly understand what's happening, because the financial advisors and the insurance agents, they're being marketed to too,
Yeah.
and they don't necessarily know that. They're just seeing, whiz bangy things that might solve problems. And at the end of the day, it's just a way to get people to buy more life insurance.
Yeah.
So let's be honest about it. But anyways, back to you, or
Well,
over
so
to
I'll,
you.
I'll tell my little story outside the military that it relates to life insurance and where the need is. So, my father was in the Air Force for 4 years, got out, went to college, University of Tennessee type, and then didn't know what he was going to do with his life. He ended up selling health and life insurance in Tennessee and did very well at that until the age of 46, where he tragically passed away of a blood clot. Like, woke up one
Jeez.
morning, had a blood clot, and just one of those things that was a freak accident. And come to find out during the autopsy, he did have cancer that we didn't know about. So it was one of those things, kind of a blessing in the sky. But at the same time, the blessing piece of it was he had life insurance.
Hmm.
He was ready, and he was able to take care of his family.
How old are you?
I was going into my senior year. It was the second day of my senior year in high school. My
Jeez,
mom
man.
was a stay-at-home mom. So as far as how to support ourselves financially, I mean, life insurance was what did it. And
Hmm.
people, I mean, the probability of things happening at that age is pretty low. I mean, based on, as you know, in the business, how much life insurance actually pays out. But I mean, it's a real, I've lived it. I mean, it is a real thing that could happen. And without that, we would have been very financially strained.
Hmm.
And thankfully I went to a service academy and my mom didn't have to pay for college, but life insurance would have paid for my college, aside from what they had already set aside for my college fund. But, I'm so thankful that, he was in that industry, and my mom had a good policy and was able to just, I think that piece of it was, there's so many stressors and so much change going through your life when you go through something tragic like that. The last thing you want to think about is your finances. So you
Right.
need at least a year or two to breathe, to figure out what the hell am I going to do with my life. And life insurance gives you that ability to sit back and breathe and transition your life properly instead of making some sort of drastic mistake. Um,
Yeah. Because so I mean, because really the way life insurance works is, because it's so low of a chance, you can get a pretty large sum in the event of a catastrophic event. It's not just like car insurance where it's just going to pay off the dents and stuff. You
yeah,
can, for a relatively low price on, at least with term insurance, that it's not that much risk financially to totally set yourself up very well,
yeah,
should something happen. But so well, that's different. So clearly you came into the military to the
yeah,
academy, age 18, already well aware of the importance of life insurance. I'm
yeah,
sure you had a big education kind of wake up call at that moment. I mean, I remember when we were at the academy, they did the SGLI form and it was like, okay, somebody's getting 400,000. But
right.
it wasn't until at least 10 years later before I truly understood what the thing was and what it was about. Did
Yeah, that was
you
the
did you
same.
talk to, yeah, I don't know, at the academy, or were you young in the military? Did people ask you about it, ever come up,
I,
or
I mean, it was the same experience with SGLI. I signed up for SGLI, and I had no beneficiaries at the time. Really, I didn't need the money except for maybe to pay off a home loan. And I said, okay, well, the SGLI was good enough to pay that off to give my parents something to cover any sort of debts I would have. So I was happy with that. But I mean, the song changed when I got married and started to have children. And it's, at least I want them to be able to, the flexibility to, not have to, my wife can take care of the kids and not have to work if something happens and pay for their college to get them to that point. Right.
Mhm.
So I think you need a significant amount, because that's the thing you don't think about is, well, how much do I really need?
Well, see,
Nobody
exactly.
really talks about that.
See, that's the problem with SGLI. I mean, SGLI we used to only be 100,000. When Jen's dad when disappeared off the aircraft carrier and never came back, they did struggle financially because they weren't set up, and I'm sure she got the SBP payments from active duty, but he was enlisted, so it's not going to be a whole lot. And then $100,000 really doesn't go that far. In 1998, what does 400,000 really do in 2022? And you know, the assumption, right or wrong, is that if I have SGLI, which is optional, by the way, most
Yep.
people, it's a 95% of people end up taking it because they think it's kind of part of the benefits and pay package.
Yeah.
And it's there so you at least have that,
Right.
because there's often times where you couldn't even qualify for something on the private marketplace when you're active duty, if you have orders to go down range, special forces, that kind of thing. And so really, that's what SGLI got put there, to make sure everybody had the option to definitely have something. But that then this is where the marketing thing comes in. It typically is around like, is that enough? Or often, how are you gonna replace these policies, or the government ones, SGLI, when you get out of the military?
Yeah.
And oftentimes, and tell me how you kind of felt about that, maybe before you got married, and thought about it a little different, or maybe kind of people you're working around. I had always got the feeling like, oh, I have that until I get out, and I'll
Yep.
worry about that later.
Yeah.
But the later thing, or the not yet thing, there's a lot of not yet. You could not yet
Yeah.
have cancer. You could have not had heart disease. I mean,
Yeah.
and this is unfortunate. I mean, I just had a policy. It was a 60-year-old veteran, and he'd been paying for VGLI, because the typical thing is, because this is what happens: the Veterans Administration markets VGLI as a replacement for SGLI. I mean, think about what you're getting in the mail, or what's getting briefed to you about what your options are, and understand that is also a form of marketing.
Yeah.
And it seems, all versions of marketing, you look at it, seem aggressive in a way, because they're just saying, this is what we have, this is what we have.
That's right.
And oftentimes you don't hear, they're not, it's not their job, and they might not even know about what the other options are. And so
Yeah.
that's the issue around it. It's really got to come down to the individual family figuring it out what they want, because this 60-year-old had been paying. So now he's about to turn 60, and all of a sudden the price of VGLI goes up. So he thought he had done all the right things.
Yeah.
Served a whole career in the military, had SGLI to cover with him, then got the Veterans Group life insurance, afterwards, paid for that for like 20 years, and now realize how expensive it's going to be, and the fact that you're just not going to be able to pay it anymore. Then there's going to be no insurance at all. And so
Well,
that
and
doesn't get part of the marketing usually.
I mean, that's what's sad, right? 20 years into it, like now you've got to pay for this product, this astronomical cost. And it's like, well, if I don't pay for it, I don't have anything.
It
Now I
goes
got to
away.
start over again. So, and it kind of forces you into having to do that. And that's
Yeah,
an
and that's
unfortunate.
that's unfortunate about this situation. So they wanted to apply for something else, and he had heart surgery, and that's not always a hard no. If it's been a number of years, or there's been recovery, but those things make it more difficult, and unfortunately, we couldn't find anything, and no other company is likely going to offer it. And in those cases, sometimes there are, kind of group term policies, but then you got to really, really shop around. And unfortunately, someone like me as an independent agent, this is what I'll get into kind of the next phase of marketing here in a minute. We're not looking at that because we recognize our best value is trying to catch those people who before they hit that situation,
Yeah.
because it can get, it just ends up being negative, especially when you're right around military retirement and you have something you didn't know about. And a lot of times they don't understand how when you go in and talk to a psychologist with his PTSD and stuff, depending on how that stuff gets written down,
Yeah.
they say something to you like, have you ever had suicidal thoughts? And you're like, yeah, I mean, who hasn't? Well, that goes into a record,
Yeah.
and the underwriter sees that, that's they're not going to give you life insurance if they think you're going to off yourself. By the way, if you do get qualified for insurance, you get 2 years. After 2 years, they can't deny a suicide claim. Just understand, the stipulations of how that works, because it is important. So, that's all the kind of like, oh, how the kind of the big picture, versions of the government versions of insurance. And then that makes it kind of obvious. Well, another company's going to come around and say, well, just get our term insurance. It's cheaper.
Yeah.
And shop the marketplace for that. You can go to a quote engine or talk to anybody like us, and that's easy to find out. Because in that case, it's just cost. What do you
Right.
qualify for? How much does it cost? So sorry.
I think, one thing that's overwhelming, SGLI, VGLI, it's just easy. It's the I believe button, because there's so many products in the marketplace. Even for me, it just seems overwhelming to figure out, like, well, term life may not be the best option. Like, I'm trying to set myself up strategically. So what is the best option? And if you went and talked to Policy Genius or some of these other places, they're just going to quote you a price. They're not going to talk about the specific individual. And most of those, especially from the veteran point of view, they don't really understand how, the specific jobs in the military that you had. They just look at it as black and white. Like, hey, you were in the military. Hey, you were an aviator. Here's your astronomical cost because you did these things. Well, actually, I'm not going downrange. Actually, I don't deploy. So the probability of something happening is less. So everybody's situation is different. And I think when you search the marketplace, that's tough, because we're such a unique portion of society that, we're not the majority. So it's harder to find the right product for us sometimes.
Yeah, no, absolutely. Well, I'm pulling up one thing real quick if I can find it. Yeah, here we go. So, no, you're right, because ultimately, this is the big misunderstanding when it comes to how life insurance gets marketed. And just pull up this slide here real quick. It's really about the two different types of insurance. Everybody knows about. Okay, here we go. Oh, I had better graphics, but I don't know what they are. This will work for now. Oh, I can share direct slides. Interesting. Well, we'll just do this till then. Okay, so we know about the typical government insurances, and essentially how things get marketed is what are their features and benefits. Exactly, kind of how does it work, and that's honestly, this is why the life insurance industry itself sucks and makes explaining this stuff and the education around it bad, because they're always talking about features and benefits versus talking to the person, understanding what their issues and problems are, and then bring those features and benefits to that table. So that, obviously that's what we're trying to do different at US Bet Wealth, or specifically around the survivor benefit plan. So, the main thing with, when you're getting out of the military and you got to replace SGLI and cover your military pension, these are the options typically available, right? The cool thing about VGLI, you doesn't matter what your medical conditions are, you have an option to get qualified. That cost goes up. We understand that there's a lump sum payment. The max is currently 400,000. I haven't heard anybody talking. So that, we talking about inflation. That's been the same 400,000. I haven't heard anybody talk about increasing that. They might bump it up if, like VA loan a little bit, but that's going to bump up the cost as well.
Yeah.
It's so unaffordable long term, which, yeah, if you live till 90 and you keep paying it, I mean, by that point, you might have paid $400,000 into it.
Yeah.
So it's not necessarily permanent, right? It is a version of a term. It's group life insurance. All group life insurance is a term. It's an extendable term, a renewable term. As long as you pay it, then you get to keep it, right? So SPP, we talk about that a lot on this channel and on our website. Go read our book about it. But the difference is here, again, it's not really life insurance. It's actually an annuity. So it's just automatic as part of the pension, but it's not a required part of the pension because that cost factor is what kind of sticker shocks people and say, wait a minute, I thought it was just wrapped in. My family will be taken care of. I got to pay for this? Yeah. It's like Social Security. You got to put money in now to pay for today's widows. Today's widows obviously deserve to be taken care of, but I don't understand why it's got to come out of today's veterans' paychecks.
Yeah.
I mean, especially when we're just printing money out of thin air. It's just what's the math here? Especially it's all taxpayer funded anyways. So why not just have the taxpayers pay the widows directly?
Yeah.
Like what is this accounting here? Oh, we got to justify people's jobs.
Yeah.
Okay. So it's taxable, of course. The cool thing about lump sum life insurance is they're always tax free. Annuities, of course, aren't. They are taxable. Yeah. And of course, there's only one option for the beneficiary. With VGLI, you can change beneficiaries. So what we look at is typically when military veterans are looking at things, they're saying how much benefit for the cost. And if looking at kind of a plot graph here, SPP is kind of I put this as our considering that's just automatic wrapped in if nobody does anything versus the other ones you do kind of have to sign up for and pay for. So this is our center point. And so how's that work out kind of on a nominal basis? You can pay less and get a bigger death benefit in a lump sum term with in a kind of a now sense with a term policy. You get $1 million term policy, you get $1 million in day one. SBP, you're getting half of that monthly paycheck every month.
Yeah,
it doesn't come. It might be worth more, but it doesn't come out that way. Yeah,
that's right. But would it? I mean, with inflation year over year, would it actually be worth more? Right? Wouldn't I rather have the lump sum up front versus, because that money is worth more,
assuming you don't blow it.
Well,
yeah. I mean, that's of course the trade-off. The people who want to be like, I just want something steady that goes up with them. Well, they add a cost of living to it. I doubt they're going to do the 7.5%. But if the idea with term is simply to pay off the mortgage, pay for the kids' college, and have some extra living expenses, we don't think that's a good strategy. That's what we do different with the spouse benefit plan. We're adding a permanency to it versus just a term, right? And so we'll get that in the next slide. But SGLI, low cost, but less death benefit. VGLI, higher cost. And so it's kind of like, what are you getting for the cost? Now, whole life is up here because whole life is a version of permanent insurance. So we'll talk about that in a second. But really, the issue with whole life is you got to put a lot of cost in to make it work out. And it's more of a kind of like owning your own home. You can get some equity in it. There's at least something left no matter how long you live. And of course, you can change the beneficiaries. Which you can't do with like survivor benefit plan, right? So, pluses or minuses, not right or wrong with these things, but these are all based on how much bang for the buck are you going to really get based on a death benefit, right?
Yeah,
a little bit of equity in the whole life, but everything else is straight death benefit. And our philosophy is, what's the probability of getting that death benefit? And wouldn't it be better if you didn't have to die to get a return on that investment? If you can increase the probability of getting some return on investment, at least versus a lot of these, if you don't die, there's no
Yeah.
return on investment, right? So that's the kind of big factors we look at when we're talking about how do we explain this to, how do we market it? Obviously, I'm still marketing. That's what this show is all about, right? I have a business and trying to educate people, and if they like what we have, they'll come talk to us about it.
Why do you think, and this may be for a different show, is like,
Mm-hmm.
whole life gets such a bad rap from, people, and I think we've talked about this a little bit in the financial world, that there's certain people that obviously don't promote it and downright put whole life
Yeah.
down and saying that, it's a terrible product and you shouldn't utilize whole life. I don't know the answer to that off the top of my head, but I just wonder why that is the one product that is always focused on, that is like, don't touch it. It's,
Yeah.
um,
No, great question, and it has to do with a couple things. So I'll bring those up. I'm glad you brought that up, and I'll mention it as I kind of talk about this, because the main thing is term insurance is the term, whole life is the whole of the life, right?
yeah,
So what's the difference between renting and owning a home for your lifetime? Cost wise, there's less cost essentially in term, and so you got to put more skin in the game with a whole life policy, right? So, all right, from your question, what does that mean? Well, how easy is it to say whole life insurance is too expensive without any other context?
yeah,
It's that easy. It's that easy. Term is cheaper. Read all the blogs. That's about as far as they go.
yeah, that's right.
Okay.
Yeah,
So, is that useful? No, it's an easy marketing frame to
yeah,
say, do you want to have to put more money in or not? High cost, that's one way. Would you call your mortgage a cost? I mean, yeah,
yeah,
but what else are you getting for it? Right?
yeah. Hopefully, equity.
So that's really what's happening is initially it requires less skin in the game.
Yeah,
So, but what's the chance of getting anything back from that? I don't care if it's low cost. If you got a less than 2% chance of getting any return on investment at all,
yeah,
is that the best option, right?
yeah,
So the difference with whole life is as long as you pay for it, whole of
yeah,
the life will be there. The issue with whole life is it's kind of an old structure version of this. I mean, whole life policies have been around for over 100 years, and they haven't necessarily changed a whole lot. They don't typically reward for health underwritings. That might be changing with different companies and
yeah,
stuff as the marketplace has grown and there's been more competition. But really, the way whole life was always sold was smoker or non-smoker.
yeah,
And so from a health status, how's that really better for a military or veteran non-smoker who's one of the healthiest persons out there? They're paying the same as
yeah,
everybody else. That's the reason why SGLI and VGLI are the same price for everybody, because the healthy
yeah.
people got to pay for the sick people or the unhealthy people, right?
I'm looking at that bullet under
Mm.
term that says low probability of ROI. Well, I don't have any ROI because I'm dead. The only way I'm
Right.
gonna,
Well, at least I mean ROI for for your family
yeah,
generally,
for
right?
somebody,
Yeah.
but for me, I'm like, I get nothing because I have to die to get it. Yeah,
Yeah. Exactly. So, the no equity thing, the way. Whoops. Uh, this is kind of, you ever heard the term and invest the rest stuff. So why would you need to pay for all the other life insurance? You can, get some mutual funds and pay the term, and then you get rid of the term when you don't need it anymore, because obviously your investments will have just done exactly what was projected 30 years before.
yeah,
So that's a huge assumption that, again, what if it doesn't work out? Now you're in your 60, or maybe you just did well and you need more life insurance to cover estate taxes, or just you want to leave a bigger legacy. Getting qualified for 60 at age or later in life, as we just talked about with the person I was working yesterday, is it is an issue there. So we talked about the equity portion, getting some money back. With the whole life, it takes a long time to really build up enough equity to use it. And even if you do want to use it, it does kind of work like a mortgage. You got to pay the insurance company
yeah,
a percentage to be able to access it. And then living benefits, that doesn't really exist, and whole life, has a little bit of living benefits. So, But just to expound upon your question a little bit more, like why does it get poo-pooed? Because whole life is meant for super, super wealthy people trying to hide their money from taxes and do estate planning so they don't have to pay the government a ton of state taxes. That's what whole life was truly designed for. And honestly, in the 80s, I think it used to be something crazy like, because the IRS, because basically whole life is tax-free. I mean, all permanent insurance, all life insurance is tax-free. Death benefits tax-free, and any equity you can access it tax-free as long as you don't put too much money in it and it becomes a taxable event. But they're designed so that doesn't happen. So that's that's just you just follow the IRS rules. They put it in the software, the algorithm that designs the policies, and that's kind of how these things get structured. But what happened with whole life is now all of a sudden you got out of the 80s, when the stockbroker thing out of the 80s and in the 90s started to turn into financial planning. We had all these companies, especially around military families, popped up thinking of say, hey, we can, rather than just pitching somebody the next hot stock, we can do comprehensive financial planning to make sure military families are taken care of. So all awesome stuff. But the obvious thing was to sell term insurance to the military families. But now, as whole life kind of got marketed more to insurance to these financial planners, because there's more money in whole life. The insurance companies and the individual agents or financial planners who are selling it, higher costs, that means higher commissions as well. So at the end of the day, we could say we're a fiduciary. I'm only doing what's the best interest of my clients. I make sure it's only the right for you and all that. Human motivation. Once you study psychology and the way the human mind works, like you don't even know you're doing it. You're going to be led to have incentives to do certain things. And so essentially that's what ended up happening. A lot of these broker dealers or these financial planning type firms who recruited all these people, and this is in not just the military market, but they recruited all these agents, and then they had private contracts with particular whole life companies. Why would they have a private contract? Because based on the amount of business they bring in, they get extra bonuses. Right. So a lot of broker dealers will say they're independent, but they only actually offer or have a direct contract with a few carriers. If an individual agent or financial planner wants to sell with a different company, they have to either do what's called outside business, which has a whole nother layer of complexity, or they have to convince their firm to go get a contract with this company. So those things combined, they got oversold. So a lot of people were getting whole life they couldn't afford. And then they got mad because they're like, wait a minute, I found out later that I could have got term. It was cheaper. When the person tried to explain to them, no, this is a wealth building tool. You can save for retirement using it. And so it just became easy fodder for the standard financial planning, save for retirement, put all your money in TSP and Roth IRAs before you do anything else with your life. Even though you're 25 and that you can't touch that money till you're 60, but that's the most important thing you have to do. Yeah. So it just became easy targets for, what are all these financial planners trying to do? They're trying to get more business. And so if they don't like whole life, then that becomes an easy way to, say that was bad and therefore mine's better. And the individual, they can't really know enough in that context, because usually that's a one-on-one setting. And so, again, another reason why I'm just trying to peel the skin back and show what the whole thing is. So here's a little graph I did, just kind of showing the history of the life insurance industry, kind of where we got to here. So the permanent and term stuff, happened, and the whole life was happening really before the internet age, especially before the iPhone. So there's been new innovations in the life insurance industry anyways. So, that's what we're looking at differently, is these modern policies don't require you to die. So now, rather than making it a cost versus death benefit, we want to increase the probability of return on investment. So that means we want to be up in this box. And there's only one type of insurance that actually does this. And that's what's called index universal life. Or I call it sometimes advanced equity. And all that means is they improved the software of whole life and added a lot more flexibility, a lot more cost advantages, a lot more access, bigger death benefits, so on and so forth. It's like a combination of term insurance, whole life insurance, and a indexed, like a C fund. all combined into one. So combining a S&P 500 index fund with a whole life insurance gives you access to growth based on the S&P 500, but the insurance part of it protects from losses. So if you were a typical S&P 500 index fund, it it would go down when the market goes down. So having inside insurance prevents that. But if you were just in whole life, you wouldn't be able to get enough of a death benefit, right? So when you combine the term part of this modern life, we can make sure we still get the death benefit at the lowest cost while also still having equity. So
Yeah.
it's really a combination of all three of those things to really. What we do is we're combining modern life as a combination of modern term or convertible term, and then index universal life or advanced
Yeah.
equity life. There's different versions of universal life, but ultimately whole universal life is the modern upgrade of whole life. There are different versions of each of those,
Yeah.
right? Just like there's different versions of term. So what we're doing here, then the way we structure it is we do the death benefit on the term because that's where the cost is. So on the equity side of things, we're really in this mostly for the tax benefits, right? And to guarantee some permanency of death benefit regardless how long you live. Just lock that in without having to worry about it again. And that's where the convertibility factor is. So we want to do a low death benefit initially on the universal side of the insurance, the replacement of whole life, because that keeps costs down. We can get much better growth, right? So we can get a higher ROI and greater cash equity than we typically can in a whole life. But we'll explain
Yeah.
because your question goes further than what you asked me for. Why do they bash whole life? So
Yeah.
just wait till I tell you what the whole life people do to what I do. So. In the convertible term, really the convertibility, we're locking in getting approved for a death benefit. Okay. That way, 10, 20 years from now, however long you have the term, you don't necessarily, that's not the first time you're trying to apply for insurance. You've already been approved. Doesn't matter how healthy you are later on. You can always convert some of that death benefit to more permanent insurance if you so choose to have it later on. And typically with whole life, it's kind of when you start it, whatever age you are, you're paying it for 30 years or for the whole of the life, and it's that same monthly payment every time. With this strategy, you don't necessarily have to fund it the same amount every month or every year. You can put lump sums in, you can take money out. It gets a lot more flexible.
But is the overall gist though, like, hey, the more I put in initially though, the more flexibility down the road I'm going to have. Is that
exactly? So that's the trade-off. So reframing it. So rather than where before it was all about, the easy way to look at it is, oh, that costs more or that costs less, and therefore that's the best decision. Where here, it's if you throw more money into an asset that's intended to have return on investment, the more you have working for you quicker, the better it's going to work out, right? So that's a complete reframing because honestly, with this, the only thing we do know of 100% probability is that you're going to die. And the most likely scenario there is it's going to be a long time from now.
Yeah.
So we can cover that, just in case scenario like with your dad fully with this. But the most likely scenario is that we're going to want to tap into it later on. Well, how do I get the most bang for the buck really when it comes to accessing it while I'm still alive as well? Yeah. So what time are we at? Okay, no set time frame here, but just I saw this article come up, and so this is a great example of an insurance marketing organization with a concept to market whole life insurance. So Bank on Yourself is a strategy to use whole life insurance instead of any other investment because the way you can take loans out, basically if you buy a car, don't go to a bank for a loan, go to your insurance policy for a loan and then pay yourself back so you get the interest yourself instead of paying it for a bank. And over many, many years, that ends up to having a nice tax-free thing. So it's a good strategy. And their issue is the new upgrade version of insurance came around, Index Universal Life, and we're just doing the exact same thing, but with the modern product.
Yeah.
And I don't know why. They're all insurance agents. They can all say the same. I can sell whole life. I just don't because
Yeah.
I did the math and there's reasons for it and they bash it all and so they write articles like this. Well, guess what I put on my website? I put an article about why maybe whole life doesn't work to replace the survivor benefit plan. So I'm doing the same thing, right? And I think this is a good strategy for people who are kind of really secure, like maybe real estate investors, really safe strategy. Older people is better for whole life to this strategy. But if you're really in a accumulation phase and you want to be able to move your money to different investments, that's where IUL becomes different. So but they got to come up with the reasons. Well, what makes one better than the other? So here they are bashing us. So it's like these are just easy things to throw out there. Be careful of illustrated value. So this is simply saying that obviously an insurance agent or financial planner is going to show you rates that are way bigger than possible because it's just going to look better in illustration. Well, okay, we won't do that. And we
Yeah.
actually, and here's the thing, the illustrations now, they have it in the software. You can't even illustrate more than 5.5%.
Yeah.
10 years ago, I used to be able to illustrate 12. So yeah, this is a valid point. All you have to do is know better to not do that. The time bomb because of costs. I don't. The cost structure of these is designed. Well, here's the problem. Here's why they're saying this. Because most people design index universal policies the same way they would a whole life policy, meaning they put all of the death benefit in the permanent policy, which requires a lot of costs later on. Because as you get older, the costs get older. So that's why we don't do that. We do the low death benefit on this. So that's a non-issue as well. Just don't design it with a huge death benefit. You buy the least amount of death benefit you're required to buy. Guarantees. Yeah, they have some of the capped insurance policies, meaning they have a cap on how much growth you can get. They'll offer some guarantees on the downside, but they only credit the if there's a 0 year, basically if there's no growth, they promise to credit a few percent. But that's only if there's been multiple 0 years in a row. And that never happens, right? So that's what they're saying, like, oh, be careful. These might not, they don't happen every single year. It's like, yeah, it's not designed that way, right? Whole life is designed to credit dividends every single year on kind of a steady basis, 5-6%. So pretty good, better than a CD. But really what a dividend is, a dividend is a return of profits to a shareholder, right? Well, mutual insurance companies, whole life insurance companies are mutual companies typically. And when they're paying a dividend to their policyholders, well, the policyholders are the shareholders in the company. So the dividend, is that not a rebate? Because how are they making their money? They're making the money from the policyholders.
Yeah.
Okay. And it's budgeted in. It's not like they're saying at the end of the year, oh, this is how much money we made. They budgeted in. They're taking their profits.
Yeah.
Let's see. Death benefit. Yeah, it's not guaranteed if you don't pay it up enough.
Yeah.
So that's the difference here. I said that earlier. People want whole life because they want super secure guarantees, and it's really meant for super wealthy people who want to make sure there's no issues there. But if you got a long time and you have good income, both of these strategies should really be designed for people in high income or planning for high income or have a plan to make high. What does high income mean? You're getting out of the military, you're getting a pension, you get another job. You're making $180,000 a year, 200. You're now in a completely different financial situation than the vast majority of people who are trying to get by, right? Yeah. So that's where these strategies come in.
Yeah.
And 99 times out of, I've had one person say they still wanted a whole life after we talked to them with this, but they've been, sometimes people look in, go down a whole rabbit hole, and it's like, listen, if you're looking at it that much, go get licensed, because that's one of the only ways you can truly understand it is to get licensed.
I've got to run in about 5 minutes. I got another meeting. Cool. Sorry about that.
Well, all right, real quick. This doesn't even say. Oh, risk. Risk is the fifth reason. That's the whole point of insurance, is to cover risk. Loan risk. That just means don't take out don't take out too much in the point of a loan. And none of these policies have a 6% loan interest rate. Whole life policies have 8% often. Most of the IULs have like a 3% interest rate. So in that way, it's also more efficient. And yeah, people, whenever there's new things and they use it wrong, what do? Instead of taking responsibility, they sue. Guess what? A lot of insurance companies, investment advisors, hedge funds, they all get sued. All the people who invest with somebody else, their money, and they pass it off and it doesn't work out, whatever they had in their head was expected, then of course you get upset. So, you know, anyway, so these are just some ideas just to talk about, just to be wary of. I thought I'd share that.
Yeah.
But no, well, I think that was fun today. And
I mean, I'd love to go like
yeah.
deeper into that discussion, you know,
yeah, let's do it.
because I think, I mean, one for my own interest as I start to get out too. I mean, that is something I'm living right now is looking at the different products and going through that. So I think it's cool to hear that and how you would strategically kind of set yourself up for that too as well. I'm the older I get and the more I've learned, whether it's investing through real estate, retirement accounts, non-retirement accounts, I am getting to the point where I feel, and again, I'm not giving financial advice of like, hey, I want access to my money before the age of 60. I don't want it to be handcuffed. And real estate even handcuffs it too at some point. So I'm not saying I love real estate, I sell it. But at the same time, it doesn't always make sense. So and you want to have that leverage. And so, yeah, I think it's a cool discussion.
Yeah, no, I mean that's what we like about this IUL strategy. I call it the war chest strategy, kind of tongue in cheek. But the idea is with this one strategy, we can participate in all these different things that a career military family is going to, you know, have at some point in their life. Maybe they're active duty and they're still put money away. They're in transition or retirement. And they got specific issues there, or they're older and about to fully retire. The point is, you know, how do we leverage your resources to protect them and get the most bang for the buck out of it? So
nice.
Very cool. Awesome, dude. Well, yeah, let you go. And hey, everybody, if you're watching this far, thanks for watching. Please share, ask us questions, stuff we wish to talk about. Subscribe to the show, and we will see you next time.
Tomorrow.
Cheers.